Good evening, everyone, and thank you for coming. I'd just like to welcome you all to the First Shield Financial webinar. Um, and you know, the idea today is just to give you some more insights into the world of note investing. And my partners and I are very pleased and glad that you're here. Today, we're going to talk about a topic that seems like an oxymoron. And there are going to be several of those that I talk about here today in our presentation. Turning debt into income. Typically, when people think of debt, they think of cash going out. In our world of at First Shield Financial, we see debt as a way to make income. And we see that as an opportunity. And the reason we titled this Seizing the Wealth Building Power of Mortgage Note Investing is that we see opportunities and we wanted to be able to share those with the rest of the world. What we're going to talk about today, we'll give you a little introduction to note investing, understanding what we call a grade A non-performing note. We'll talk a little bit about investing in non-performing. We'll talk about our due diligence and the due diligence process that we have. We'll also talk about our exit strategies. And when we buy a note, we have a plan for every note. We'll give you a case study. We'll talk about the covenant fund, and we'll also talk about how to build passive income. And then finally, we'll follow up with a little Q&A session to try to answer any questions that you have. As we're going along, if you do have questions, just go ahead and type them in the chat. And at the end of the presentation or in the Q&A, Raman will read those off, and we'll try to, between the three of us, try to answer those questions for you. Just a little bit of information about First Shield. Our focus is to unlock the potential of mortgage note investments for our clients. We're committed to providing innovation and reliable investment solutions, all within the framework of the expertise that we have, with integrity and driving results and having results-driven strategies. That's the last slide that I will actually read today. So to begin, I just want to sort of talk to you about what is a mortgage note. For many folks, they hear the term, they hear us talking about it, but they don't know where this concept comes from and what we're really, what drives this business. So to start with, when you buy a house and you go to closing, there are two big packets of documents that you sign. One is called a mortgage, and the other is a promissory note. Those documents, the promissory note basically just says, I promise to pay the lender with certain terms, conditions, interest rates, and so on, and payments. The mortgage pledges your house as collateral if you decide for making that payment, or to guarantee that you'll make that payment. So typically, those are the documents that we're talking about. After you go through closing, typically within a week, a month, several years, something like that, your original lender will sell the mortgage. We are the folks that buy that mortgage. So many of you have had experience of seeing that letter in the mail. We'll be the folks that are buying the mortgage. Some people will ask, well, why will a bank sell the mortgages? And it's primarily so that they can get more money to write more loans. For us, one question is, so why do we buy these things? What is the purpose of owning a mortgage note? One of the reasons we buy is because it's a steady cash flow stream. If you think again, going back to that example of you have a mortgage, most people pay their mortgages on time. So because of that, you have that steady cash flow. The other reason we'll buy mortgage notes is that there's a level of liquidity which is higher than if you own real property, in real estate. If you think about a house, if you needed to sell that house, it may take you months. You have to clean it up, get it prepared, get people moving in and out to try to sell your house. If you buy a note, the secondary market, the market that we buy from, is fairly liquid. So for our investors, for what we do, we can generally get in and out of a note in a few weeks, a month at the most. The other reason we buy mortgage notes is because it's secured by the collateral. It's secured by that house that is the underlying asset here. As a result, we're pretty confident that we're going to get our money back. And as we talk through the presentation, we'll tell you more about some of the exit strategies that we have and why we're so confident that we will be able to get our money back out of any of the notes. The final reason that we invest in mortgage notes is we get above average returns for other fixed income type assets. So, and that again is another solid reason for wanting to get into this investment class. For many of us, we've invested in hard real estate. That's where I came from. I know Kim, my other partner, and Raman also have invested in solid assets before. One of the reasons we liked and one of the reasons we transitioned over into the note business is because we got tired of the tenants, the toilets, the trash. And frankly, it always seems like toilets break at 8:30 on Friday night. So getting away from that, getting away from actively managing real estate was what our purpose was for starting to invest in notes. The other reason we invested in notes is because it allows for us to collect a monthly payment. We're getting interest instead of rent. And again, because people that buy homes are going to be paying, we can expect to get payments for as much as 30 years, in some cases even longer than that, off of a single note. Why? And again, the contrast between owning a property and being a landlord, you don't know how long your tenants are going to be in that property, but typically they're not going to be in there for 30 years. So the other thing that happens, the folks that are borrowing are going to take care of the properties. Our specialty at First Shield Financial is we do non-performing notes. Now we will buy performing notes as well. We have a fairly sizable number of performing notes in our portfolio, but our specialty is non-performing. That sounds like an oxymoron. People have asked us, why would you buy a mortgage note where the borrower isn't paying the mortgage? And for us, it really makes sense. We're buying something that has a lot of value, and frankly, the reason we only buy what we consider grade A notes. So what's a grade A note for us? Well, all of us know bad things happen to good people and life happens. You have divorces, there are deaths in the family, people lose their jobs. For us, a non-performing note is one where the borrower has been in the house for quite a period of time. They've built up some equity. They have some emotional value in that house. It's a nice house, nice neighborhood. They're not planning on losing that house. Before that event happened, it was rated a grade A note, because this is the type of note any financial facility or any financial institution wants to have. The event happened, and all of a sudden their credit fell off. The note's value to the lender dropped because they weren't getting regular payments. As a result, we're picking up notes that are really very valuable at a really steep discount. The lender of record, the lender that has a note that is non-performing, wants to get that off of their books so they can get cash in, so they can make more notes that are performing. As a result, we buy those notes, we buy them at a fairly steep discount, and that's what helps us to get the types of returns that we're talking about. We also use these notes to generate passive income. And what do we mean by that? We feel that mortgage notes, and we've seen that mortgage notes have a low volatility. particularly compared to things like stocks and other traded assets. They're secure because of the collateral. They have a long-term payout, a long-term history, and frankly, and I've done this myself, it's great for retirement accounts. For folks that are looking for something for a long term to build up wealth over a long period of time, these are an excellent asset class to be involved in. That's why we do this, and this is why we feel it's a great way to build wealth while also generating passive income. I'm going to shift gears here a little bit and talk about how we're able to grow in this asset class. First, I want to talk to you a little bit about how we begin finding our nodes. We've built up a really good network of reliable sources of nodes. We buy notes from your biggest banks. We buy notes from credit unions. We buy notes from hedge funds. We buy them from other investors. And because we've built these relationships, we know that we have a consistent source of notes. We see dozens, if not hundreds of notes a month, and have our pick of what do we want to buy. The other thing that helps us is we have a very comprehensive due diligence process. And in that process, we're looking pretty deeply at the notes, and the folks on our team have a lot of expertise. Our team consists of a licensed appraiser, a mortgage loan originator, an MLO. We have a real estate agent. We also have folks that have experience in government compliance. So those are the folks that are looking at every note deal that we have. And as a result, we find really good notes. We know that we're going to have a really good, a lot of success with those notes. And the team has every aspect of due diligence covered. All right, diving deeper into our due diligence, we only buy the highest quality assets, and we do that as a way to kind of reduce our debt, our risk, and increase the profitability that we have in our notes. We buy, as I said, we buy from solid sources, and we're able to unearth some really good gems. You'll see that when I go through the case study, and some other things that and as we're going through talking about due diligence, I'll also talk to you a little bit about some of the things that we've uncovered as we're going through diligence, and notes that some of our sellers are unhappy that we bought from them because we were able to kind of steal them from them. The other thing I'll tell you is that the diligence helps us to understand, as any place in real estate, we make our money on the buy. So we know when we buy a note how much profit we're going to make. The only question is, how long is it going to take us to get to that profit? Diving a little bit deeper and taking you through the diligence process, the first thing that we look at is the value of the property itself, the underlying asset. We want to make sure that that asset is in a nice neighborhood, that there's equity there. We look to make sure that it's in an area that's growing as opposed to an area that's declining. So there's certain parts or certain geographies that we won't look at because of things like that. We also look at the region of the the region of the country that the property's in, and we look at what kind of litigation environment is there in that particular jurisdiction. So property is the number one thing. We want to make sure we have a good asset. Even though we buy from really solid sellers, it's not uncommon for a big bank to have a property that has an issue in it, and we will find that out during our due diligence. The next step, for every property that we buy, we put eyeballs on it. We've never purchased a note where someone associated with us has not looked at the property. And if you go through our files, we have pictures of every property that underlies the notes that we own. Because of that, we see things that the sellers don't see. When I say that, some of my sellers are not happy with me for what I've done, one of the notes, actually several of the notes that we've purchased, we've seen in the course of our diligence that the houses were for sale. In that case, I'm holding my breath that we can get the house before it closes, because I know within 2 or 3 months, we're going to get paid 100% of what we're owed. So property inspection is really important to us. We also want to verify whether or not the property is vacant or not, whether the borrowers are still there. So that's part of that piece of the diligence. The other piece of the due diligence that we do is we do a very deep dive into a borrower's financial situation. We want to understand who is the underlying, who's responsible for this loan and their underlying situation. So as I mentioned earlier, bad things happen to good people. When we're diving in and we're looking at someone's credit history, we'll see that they were consistently paying every bill up until the point that something happened, and then they got into this situation and now they're behind on their mortgage. Because of that, we know that we can probably work with that individual and come up with a way to get a return, the type of return we're looking for on our notes. The final thing that we do is we do a very deep analysis of the paper. The paper being the mortgage, the notes, the chain of ownership for that, making sure that that's intact so that we know that if worst case happens, we have something that we can collect on. Because we don't want to have we don't want to have a collateral file that is defective because we wouldn't be able to collect our money. So we do a very deep analysis of that as well and make sure all the documents are originals. I mentioned we make our money during the due diligence. Also during the due diligence, we understand what our exit strategies can be for a particular note. In the note business, there are only three things that can happen to a note. And, if you think about real estate and any other type of real estate, if you're a landlord, there are a gazillion things that can possibly happen to you. In this space, only three. The borrower will pay as they've agreed, as it says in that promissory note. They'll pay the loan off early by either refining or selling the house or something of that sort, or they'll fail to pay. And even if they fail to pay, there are only three outcomes. And I go back to, we'll come up with a plan where they will begin paying. We'll modify the loan, something of that sort. They'll pay it off early by either selling the property, getting it refied, or if that does not work and they can't pay, we can either do a cash for keys, buy and take the property that way, or worst case, we can foreclose and get our money back by selling the property or going through the foreclosure auction. I want to talk to you a little bit about some case studies so you get an idea of what we do and some of the real world successes that we've had with non-performing notes. For some of you that have seen me on podcasts and other presentations, you've heard me talk about the DC note. And I'm going to talk about that in a little bit of detail here. The reason I do this particular note, we have and when you go through our some of our offering packets, you'll see a lot of other case studies, but this one kind of encompasses every aspect of a note and a non-performing note. In this case, we bought a non-performing note, a non-performing second in the District of Columbia. The property value was about $500,000. The first mortgage was about $237,000, and the borrower was making monthly payments on that consistently. There were no issues there. That mortgage was current. The second mortgage, the borrower owed about $48,000 and hadn't paid in 10 years. The hedge fund that sold it to me, I don't know, for whatever reason, they never tried to collect. So the borrower was behind by 10 years. You would think that maybe I would not want to buy that note, but we wound up buying it anyway. And one of the reasons we bought it, the equity on the house is $170,000. So we knew that there's a lot of room there, there's a lot of opportunity, and I was pretty confident that the borrower would want to work with us. The other reason we bought the note is that we bought it for $16,000. So it was a steal. We bought the note, and as I mentioned before, we think about exit strategies when we're buying the note. So one of the strategies that I was thinking about is there's enough equity here, interest rates were really low. The borrower would probably refi, pay me off, and put a little bit of money in his pocket. His ultimate payment would be lower for combining both of those mortgages, and life goes on. He didn't do that. The other thing I thought was, well, maybe we can cut a deal with him. I bought the note for a really low price. I could forgive a lot of the interest and the late fees, and again, walk away with, $40,000, $50,000. He didn't talk to us about that either. Ultimately, we had to foreclose on this property. In the foreclosure, where, we bought the note and I was willing to negotiate and give the borrower some really good discounts in order to be able to get our money, the judge said, how much does he owe? I said 92,000. The judge said you get 92,000. As a result, with this particular note, we got a 578% return in it took us about 14 to 16 months to be able to get that settlement. So a really good return. This is why we do non-performing notes. As I mentioned, we buy them at a really deep discount. We buy stuff that the other lending institutions don't want because they're trying to raise cash to do performing notes. And that's why we're able to get the types of returns we're talking about. I want to briefly talk to you about how you can get involved in doing this as well. So note investing, we look at it is a consistent passive investment. It's a consistent cash flow. It's secured by collateral. So you're able to sleep better at night. And it also has a higher return on investment. So for us, one of the things that we've been trying to do is to share with people our experiences to get more folks involved and more folks interested in investing in the note business and in the note space. As a result of all of that, we've set up the Covenant Fund. And the reason for doing that, I have a mentor in the note business, a gentleman that I talk to regularly that helps me understand the business better and that I can consult with whenever I have issues. My mentor saw how much money we were making with non-performing notes, and he wanted in. And so in order to convince me that I should let him in, he suggested that we start a fund. And that was the genesis for the Covenant Fund. I set up the fund because I realized, and through my conversations with him, that our team has knowledge that allows us to be able to generate some really good returns, and that there are other folks that are very interested in participating with us. So that was why we started the Covenant Fund. Also, another benefit for having the fund is it will allow us to buy notes in even deeper discounts because we can buy larger pools of notes. So Covenant Fund, the purpose of the fund is to invest in quality mortgage notes. We're going to be primarily investing in non-performing notes, both non-performing first and non-performing second. You see the types of returns we're talking about there. We're also going to be buying and diversifying and buying some performing notes in there as well. The fund will give a quarterly return based on the amount of money that an investor invests. At the end of the term, which is 5 years for this fund, we return 100% of the capital for those folks that have invested with us. And as a added benefit, we're also going to be dispersing half of the profits that we generate from the fund to those investors on a pro rata basis. The fund has 4 classes of investors, and the fund is open for accredited investors. So Class A investors are those that invest over $1 million. There's a 12% return. Class B, for those that are investing 150 to $1 million, it's a 10% annual return, again with quarterly distributions. Class C, 75,000 to 150, 9% return. and then a Class D investor, 25,000 to 75,000, an 8% annual return, again with quarterly dividends. And in addition to that, there's the 50% share of the profits at the close of the fund. So Covenant Fund, it's a passive way to build wealth and regular income. And we feel that it's great for retirement accounts and any kind of account that you're putting your money in that you have a longer investment horizon. We're going to be investing, as I mentioned, in really high quality notes. So both performing and distressed mortgages. You get your quarterly yield, and 100% of your capital is returned at the end of term, which is 5 years, so 2029. And at the end of the term, as I mentioned, all of our investors are going to be receiving half of the profits that we get on a prorated basis. So that's a little bit of an overview of the Covenant Fund. At the end of our presentation, we'll have a link that you can, or URL that you can click on to be able to get to the to some more information on the fund. So what we want to do is I'd like to work with you to help you build your financial wealth. As I mentioned, we have a passive, consistent, secure investment opportunity. And what I'd like to be able to do is to talk to folks, anyone that's interested on this webinar. You can click on the URL that you see on the screen. That'll take you to my calendar and allow us to have a one-on-one conversation so we can talk to you about any types of and how this investment can work for your portfolio or what you're looking for in terms of the types of returns you want. Also, to give you a chance to find out a little bit more about our expertise and what our team can do. With that, I'll turn it over, open it up for questions. So, Raman, do we have any questions in the chat?
Yes, Jerry, we do have a question from William. Is there a date when we can start participating in the fund? And is there a deadline when the fund shuts off?
Okay. So what I'll tell folks is essentially Covenant Fund 1 started in September. So we are currently actively seeking investors for the fund. You can start at any time that you want. What I will say is that if you are interested, now is a good time to start gathering more of the information about the fund. If you click on the link, it'll take you to the executive summary, but the next step is the private placement memorandum. So I would suggest that if you are interested, click on the link, get the executive summary, and then move in and get the PPM so that you can start to understand what the fund is about, who are the sponsors for the fund, to see if it's the right type of thing for you. The other thing that I'll suggest is also click on the link to get on my calendar so we can talk about it and see, does this make sense and how can it best work in your portfolio? As far as timing, we're trying to get the fund closed out early next year. So it would behoove you, if you are interested, to invest to get going as quickly as possible. Any other questions?
There are no other questions in the chat right now.
Okay. If there are no other questions, I see we have a few other folks on the call, and I know that there was a little bit of a difficulty getting in. Kim, do you want to open it up?
Let's see if I can get to it. I'll have to stop sharing if I open it up.
Okay.
And I think everybody should be able to unmute themselves if they would like to be able to say anything or have any further questions? One of the things that I would like to note at this point is that the fund is a big deal. And so with that, we'll be having a conference in a summit in April 5th. And it would be dedicated, and all the information will be surrounded around the fund. So if you have the opportunity, go ahead and save the date for April 5th. This will be in Ponte Vedra, Florida. And let's see, it's a one-day, all-day event. It's at a very nice place. You might want to take a look at what is it, Sawgrass Marriott, to see and plan accordingly. But we're very excited about the speakers that we're lining up for this event, and to support and lead people to further information about the fund.
Yeah, cool. Yeah, and the title of the seminar is Wealth Protection Summit.
Wealth protection.
So a lot of the speakers will be talking about things around financial planning and other aspects of wealth protection. Okay. So with that, I'd like to, you want to put the URL up on the screen?
Yeah, I am. Sorry about that. The share is always challenging.
I knew I shouldn't have had you take it off.
That's okay. Here we are.
All right. So I'd like to thank everybody for spending, your most precious asset, your time, to hear what we had to say about notes. And Kim is going to show you, or put on the screen, the URL, which will allow you to.
Yes, this is the link that will take you directly to the information for the Covenant Fund.
So that'll give you a link to the executive summary.
When you get there, you'll be able to get to the executive summary as well.
Yeah. And I think there's also a link there. If you have any other questions, you can get on my calendar as well to talk to me about it.
Yeah. Let me, yeah, this QR will take you directly to your calendar.
Cool. All right. I want to thank everybody for participating today. Hopefully you got some good information out of the presentation. And if there's any more information you want, please give me a shout and we'll talk to you.
Okay, thank you.
Good. All right, bye-bye.